on pace for the biggest quarterly gain since March of 2022. So are more gains ahead, or maybe is it stalling out? Joining us now is BofA Securities Head of Global Commodity Research, Francisco Blanch, and again, Capital founding partner, John Kilduff. Good morning to you both. Francisco, first, love your perspective on, I guess, how we got here to, $91, $92 Brent crude. Is it purely a supply response in the markets, and does it continue?
Hey, thanks for having me. Yeah, I think there's supply at hand here. We've had lower volumes from Saudi Arabia for 12 months running. Remember, they started cutting supply around $95 a barrel on Brent in September of last year. We've also had Russia joining Saudi Arabia in the last 3 months or so with pretty deep cuts after really maximizing volumes for much of the prior 9 months. And then, of course, we've had some refinery bottlenecks that have triggered higher diesel and gasoline prices at the pump. So all of those factors have been pushing oil higher in combination with a Chinese demand story that, frankly, is not great, but it's not all that bad either, with transportation coming back from the COVID lows last year.
And at this level, Francisco, I mean, we had a better clearing price. Obviously, North American production has remained, not far from records.
Yeah, I think we're a better clean price. Maybe there's a little bit more upside. We think if OPEC sustains the cuts into year end and demand continues to hold up as it has across most of Asia, we'll see triple-digit oil. Remember, inventories did come down in August, are coming down in September, and they're likely going to come down in the fourth quarter as well. All of that creates momentum to the upside. Now, I think the question is 2024. Are we going to hold up at these very high levels if demand starts to wobble, if those high rates continue to bite into the economic outlook?
Yeah, John, that's exactly where I was going to go next. You have the rest of the asset markets that are kind of caught up in this concern about higher yields, whether it's going to really slow the economy, and yet you've had oil going high alongside it. So how do you read it?
Well, I read it as a real mixed bag, Mike, and good to be with you. In that, obviously, look, Mohammed bin Salman of Saudi Arabia is unbelievably committed to engineering a higher oil price so he can get more revenue for the public investment fund so he can embark on his GDP growth dreams. He talked at length about them at last week's BRICS conference. It's coming at the expense of U.S. drivers. Make no mistake about it. So I think further gains from here, though, are going to be hard fought. As we were coming on air here, I saw a Wire Report headline that Evergrande had a major bond default in China. They're a major real estate lender there. So it speaks to the problems in the Chinese economy that has been a real headwind for this oil price rally that would otherwise be taking off here. They are as essential to the price picture from the demand side as the Saudis and now Russians are on the supply side. So to the extent that these interest rates also stay higher for longer and inflation comes down and it's effectively a even greater tightening by the Fed de facto, we are going to continue to have headwinds for the oil market. So a lot to be afraid of, but I'd say just hold on here and just remain calm, as they say.